This is our Forex plot for October 22nd, 2013, and these are our currency indexes, which shows you graphically, as if it's a regular chart, which each individual currency is doing. Here's the dollar. You can see it trended up into, it hit the previous day's high, pulled back, came up again, double topped at the previous day's high, and you can see right at a little bit around 4:30 here, it's likely to reverse. It tried to go higher, double tops oftentimes are the high, and then it broke back down underneath the hourly moving average, never got above it, and then collapsed. And when you have a currency that's weak like that, you want to sell it against the currencies that are stronger. You can see the euro was up to the previous day's high. It pulled back a little bit, and even before the explosive move up around 8:20, it broke back from below to above the hourly, and the dollar was already underneath the hourly, and so you want to basically look for buys in the euro dollar. Now here's our Forex signals. You can see there was a buy here that failed, a buy here that got you in a little bit early, and then you luckily caught that huge move. You can just use many different methods for exit. You can use support resistance, Fibonacci profit targets. Typically, chandelier trailing stops work pretty good with 1.5 ATR. And so you'd have been in this trade and out right here. You would have been out at 37. In this trade here at 70. So that's a 67 pip move. In here again, much smaller profit there. Buy again right here at 48. Out at 78. So a nice 30 pip move there. And you can also use a digital signal processing based moving average. They're super fast, and what you want to do is use maybe a 5-period moving average shifted 2 bars to the right. Click DSP. It makes a very excellent profit target. And so if you bought right here, you wait for price to kind of go above it, and then if it breaks down underneath there, wait for it to go 1 pip underneath that bar's low. So it never really does until it goes underneath it right here. So you'd get out of your trade right here at 36. And so I frequently do that myself. So you would be in this trade right here, goes up, you have a close underneath the line, the moving average, you wait for 1 pip underneath there, a close. You might get out of this with a small win, or you might stay in a little bit longer. But the point is, that's another method of getting out. You can also use a parabolic stop, and there's just a slew of other ways of getting out. But in a nutshell, the signals are for either new traders or experienced traders, because the accuracy of them have gone through the roof. As you can see today, 1 loser, 1 win. So it's 50-50. 2 wins, 1 loss. 3 wins, 1 loss. 4 wins. That one moves at least a couple bars your way. 4 wins, 5 wins, and this is probably going to be a loss, but it's not over yet. So the majority of the signals, we're pretty picky on what we consider the market strong enough to buy or weak enough to sell. Plus, we have very sophisticated counter trend methods that kind of let you know when the market's moved statistically too far, and very important, the momentum has slowed. So if the market's going up and it's up too much, but the momentum's still strong, we do not show sell signals until the market kind of dies down. It's taken me months to perfect the counter trends signals, and I wouldn't say they're perfected yet, but you can see, not getting short here or here or here and nailing the high is pretty good. So manually trading, you basically want to find a currency that's weak, like the dollar. The yen's weak also, so you could have bought the euro yen today as well. Let me just bring up a 5-minute chart. Doesn't matter what time frame you use. The euro was strong, the yen was weak. You're very likely to have a pretty explosive move on this one too, and you can see it went up about 100 pips. The pound was kind of choppy, and it didn't have the daily, weekly, monthly trend up that the euro had. Let's see what some of the other pairs have here. You can see the Australian, very strong. So buying the Australian, which is strong, versus the dollar, which is weak, is also a very high probability trade. And if you want to go to a 5R chart, these are range charts. But these are what I consider to be some of the higher probability trades. You know, which one's strong, the other one's weak. Look for a 3-bar pullback. You get long when it closes up after 3 bars plus down. Your stop's underneath here. So you have a small win here. And you might have a loss here. You go back in and again here. You have a huge win. And sometimes the market kind of comes down, up. I'll sometimes get into those trades, you know, for a small profit. Pullback, you know, rectangle pattern, breakout. And once it goes up statistically too much, I'll typically avoid 2 to 3 bar pullbacks and wait for 2 waves down before I buy. So 1 wave down, 2 wave down, and you can see that one also worked. So how to determine that is based on our containment bands. You put the containment bands on there, and you might want to see where the simple moving average is on the hourly chart, and then add it again with the digital signal processing based bands, and I add the 1.5 and 2. When they get over the 2.0 band, which today they should have, it's pretty risky to buy at and above the 2.0 band. You know, so these are based on the last 20 days maximal volatility. If you want to buy this pullback right here, this was even better knowing that the hourly moving average is here, and this makes a great profit target as well. This is kind of risky, but it did go sideways for about 30 minutes, and it had every opportunity to pull back and go lower, and it didn't. And you also want to draw your fibs on these waves because they make really the ideal profit targets. When it gets to and above the 1.382 fib target, especially when it's above the bands, it's pretty much dead. And so if you bought this breakout right here at 04, you're out here at 26 for 20-something pip profit. And you don't want to be buying right here because the profit target, again, is right there. A lot of times markets double top at the fib target. So even though, you know, it might be a slightly bigger potential profit than your risk, it's not worth it. You know, wait for a pullback and get in right here. And even though this trade didn't take off, at least you have a chance of it going back up at least 50-62% of the pullback. And so that is 2.5 to 3 times bigger than what your risk is. And that's the only key to trading. Small losses, big wins, focus on high probability trades. When the market's up too much, wait for a 2 or 3 wave pullback, depending on what the statistical momentum is at the time. So that's, you know, good, high probability, low risk, searching for trades that are likely to give you 2 to 3 times more profit than what your risk is. That's the real secret to trading. There's nothing else you really need to know. Whether you use our software and our statistical tools and our Forex Signals or some other platform, you know, obviously you have a loss here, huge win, huge win, huge win, small win, and pretty much just hasn't probably stopped you out yet, but it's probably going to be a loss. If it doesn't, usually trades that don't take off within 1 or 2 bars tend to be failures, and I tend to get out of them right away. You can always re-enter. Plus this is up too much, so myself personally, I probably wouldn't have even taken that, probably wouldn't have taken that. I would have exited my long trade with this short here and also taken that trade too.